Hi traders, I'm Ross Maxwell and welcome to the latest edition of the Keyzone Traders Trade of the Week. This week we're going to look at a day trading strategy on the DAX again. It's different to the one that we reviewed last week, but nevertheless it's a day trading strategy we trade on the open on the DAX. This trade happened on Wednesday and it teaches some lessons about two principles that we spoke about in my free startup course that was launched this week. The two principles that we can learn and take lessons from are slippage and also the importance of risk. So if you haven't already signed up to the free startup course, there is a link in the box below where you can come and sign up and look at the key trading principles that we teach here at Keyzone Traders. So I hope you find this useful. Let's go look at the charts. Hi traders, so welcome to the latest edition of the Trade of the Week. As mentioned, this is a trade in the DAX that we take on the open, and it provides two important lessons around one, slippage, and two, the importance of risk. So in my free startup course this week, I talk about slippage and I talk about how, because we trade really liquid markets, we do not suffer big slippage that often, and in true poetic style I took the biggest slippage on a trade that I've actually had in my trading career. So we're going to look at it, we're going to take a look at how that affected my risk and the impact that it had on that, just so something you're aware of as well. So I know in the first session of my Trade of the Week, the first edition of my Trade of the Week, I spoke about I would do the best setup. I actually think what I'm going to do is I'm going to show you the trade that you can learn the most from. Obviously, the great setups and the best trades are beautiful to watch, but we don't actually really learn anything from them. So I'm going to pick a trade where we can take the most lessons from, and that's a trade that I'm going to review each week. So some of them will be perfect setups that go to target just because we can actually learn something from the setups. But generally speaking, if I'm going to pick the trade that we can take the most lessons from. And this week it is this trade on the DAX. So the market opened at 8 o'clock here. Let me just put an arrow in here. This was where the market opened on this candle here. So we got quite a lot of chop, and then we had this quite big impulsive candle down, a little bit more chop, and then we actually got our sell signal on this candle here at 8:15. So with this trade, we had an entry of 15,442 there, and we had a stop at 15,554 there. Now with this strategy, we actually go for a 2-to-1 target. So we had a 12-point stop. We were going to go for a 24-point target all the way down here at 418, which is there. And the reason that this was quite a nice target as well was because we had what is known as an extreme gap, in that the previous day's high was down here, and the market opened above that previous day's high. So there's a gap in the market where there's nothing, no trades have been able to be facilitated, and therefore it is a level that can attract. So it was quite a nice target that tied in with a signal that we had. So as you can see, we got triggered into the trade. So this was the signal bar. We got triggered into the trade here, and then we moved around a little bit, and then there was this really big spike up. It happened really quickly. It went through our stop, and actually we got stopped out at 15,461. And then again, in true poetic style, the trade turned just after it stopped us out up here, and turned and went all the way down and hit our target. So when that happens, it is extremely frustrating, but I can take solace in the fact that my read on the market and the signal was right. Just in this instance, the market does what it can do at times, and it took me out and stopped me before going and doing exactly what I expected it to do. Now, let's have a look at this. So I had a 12-point stop. My stop was at 12,454, and I took 7 points of slippage. The most I've ever taken before Wednesday was about 3, maybe 4 points worth of slippage on any market, because, as I say, I trade some of the most liquid markets that there are out there. So I took 7 points of slippage. Now, this was a 0.5% risk trade for me. So based on a 12-point stop, my risk was 0.5%. But actually, I was taken out for a 19-point stop, which was more than half of my original risk. So my actual loss on this trade, even though my original hard stop had a risk of 0.5%, my actual loss on the trade was more than 0.75. It's about 0.77%. Now, there's nothing that we can do about this, unfortunately. Slippage is just part and parcel of trading. I can assure you that this type of slippage does not happen often. There is not normally that material change in the amount of risk that you put on. But it does also demonstrate the importance of leveraging sensibly. A 0.75, 0.8% loss for me is not a big deal. I can make that back up in one trade. And it's not emotionally damaging to me. It's frustrating that it happened, but from a psychological point of view, in terms of my P&L and my account, it's not damaging at all. I know that I can make that back up in one trade. Now, imagine that you're risking 4, 5, 6% on that trade. You're actually going to lose, in this instance, somewhere between 6 and 10% of your account on one single trade. And that can then lead to more psychological issues and more emotional, potentially emotional issues when it comes to trading, and leads on to revenge trading and chasing losses and stuff, which then leads on to a detriment to your trading account. So it's really important lesson on the importance that we leverage sensibly and we have sensible risk controls, but also demonstrates that these things can happen in the market. So I hope you found that useful, and I'll speak to you next week.